In today's interconnected world, the ebb and flow of money across borders can seem as dizzying as a roller coaster ride. The movement of capital, driven by intricate rules and influenced by multifarious factors, forms the backbone of international finance. Understanding how this works isn't just for economists or finance students. It's increasingly relevant to everyone's daily lives. Let's take a journey through the fascinating world of global money moves, breaking it down into more digestible bits along the way. At the heart of international finance are currency exchanges. Imagine for a second that you're traveling from New York to Paris. You'll need to convert your dollars into euros, a seemingly simple act, masking a complex global system underneath. Currency exchange rates are influenced by factors like interest rates, inflation, and geopolitical stability, turning even a short trip into an exploration of economics. This significant ballet of money involves not just tourists, but large corporations and countries. Why do you think your holiday in Paris is more affordable some years than others? It's not just the airline ticket, but the exchange rate that holds sway. Let's talk about trade for a moment. Goods and services fly across international borders every second, necessitating exchanges between different currencies. Exports and imports are the strings that tie countries together economically. Take, for instance, a smartphone. Parts may be manufactured in China, assembled in Vietnam, and sold in the United States. Each transaction in this supply chain involves multiple currencies and financial considerations, critiquing any notion that goods are handled by only one nation. The process smooths out the economic disparities between countries, spreading wealth and innovation globally, though not without challenges. Then there are multinational corporations, the behemoths straddling different continents, bringing us everything from technology to groceries. These businesses have to navigate the choppy waters of international finance daily. Imagine a company like Apple. Their financial operations incorporate multiple currencies and regulatory landscapes. They must hedge against potential disruptions in exchange rates, cleverly maneuvering to maintain profitability. This makes them a crucial player in how global currency flows are directed. A key player in international finance is the central bank of each country. These institutions wield enormous power in controlling money supply and setting interest rates, affecting everything from inflation to employment levels. When a central bank like the U.S. Federal Reserve decides to raise interest rates, it causes ripples across the globe. Investors might flock to the U.S. for better returns, strengthening the dollar and affecting export competitiveness. Central banks use these tools to stabilize their economies, but this requires a precarious balancing act with global implications. Emerging markets present a fascinating dimension to international finance. Countries like India, Brazil, and Turkey are on growth trajectories, attracting international investments, but also facing unique risks. These markets offer potentially high returns, but investors must also consider political instability and less predictable fiscal policies. Money moves into these countries can spark growth, while sudden withdrawals can just as easily lead to economic tremors. It's like adding a turbocharger to your car. There's potential for greater speed but an increased risk of losing control. On the flip side, we have foreign debt, a double-edged sword for many nations. Developing countries often rely on foreign loans to fund infrastructure projects or stabilize economies. While this can catalyze growth, it comes with the burden of repayments, often in a dominant currency like the US dollar. If the borrower's currency weakens, paying back becomes more expensive, setting off economic distress and potentially leading to a debt crisis. It's like borrowing a cup of sugar but needing to return too. We would be remiss not to touch upon the role of international organizations in financial stability. The International Monetary Fund, IMF, and the World Bank are lifeguards of the global economic pool. They provide financial assistance, policy advice, and act as forums for economic cooperation. These institutions often play pivotal roles during financial crises, offering support packages conditioned on strict economic reforms, steering struggling economies back towards stability. Think of them as the mechanics that keep the engine of global finance finely tuned, though sometimes critiqued for their methods. Technology has also revolutionized money movement. The rise of financial technology or fintech, including digital currencies like Bitcoin, has disrupted traditional financial systems. These innovations offer new ways to transfer funds across borders, bypassing traditional banking systems and the often cumbersome process of currency conversion. Cryptocurrencies in particular bring debates to the fore regarding regulation, stability, and acceptance. They promise lower transaction costs and quicker settle times but come with risks like price volatility and security concerns. Let's not forget the influence of global events. A pandemic, a natural disaster, or a political upheaval can send shockwaves through international financial markets, reflecting just how interconnected we are. The COVID-19 pandemic, for instance, brought an unprecedented hit to economies worldwide. Stock markets tumbled, governments injected stimulus money to prevent collapse, and global supply chains faced unprecedented disruptions. Such events underscore the fragility and resilience of international finance, testing and sometimes rewriting the rules of engagement. At the grassroots level, individual remittances form an understated yet crucial part of the global financial puzzle. Overseas workers sending money back home contribute significantly to the economies of developing nations. This flow of money helps with household expenses, enhances disposable income, and can drive small-scale local investments. Remittances serve as a lifeline for many families and effectively move money across the globe, albeit in smaller, more personal transfers than corporate giants. Understanding global money moves is akin to reading a complex novel, where every character, from corporations and governments to small businesses and individuals, plays a role in a story constantly in motion. Policies change, crises erupt, and technologies advance, each chapter offering new challenges and opportunities. By following these threads, we gain a better understanding of how interconnected the world truly is, turning what once seemed like arcane knowledge into a captivating narrative that impacts us all. Ultimately, the journey through international finance reveals it as a dynamic tapestry of money, power, and human interaction. It's a dance of risk and opportunity, strategy and chance. Whether watching the dance unfold or joining it directly, understanding these global movements empowers us all to better navigate the financial world stage.